guys, it's going to be an introduction to buying and selling stocks. If you've never traded before, this is going to be the video for you. I'm going to go over how to buy, how to sell, the different types of buys and sells. We're going to go over what a stock price is, why it is what it is, and then why does it fluctuate. And then I'm just going to do a quick overview to get you started on one of the trading applications that I started on myself. So let's get started. Again, we're doing an introduction to buying and selling stocks. We're going to go over what a stock is, and as we see here, the stock is not a share of ownership of a company. Shareholders own shares issued by the corporation, and the corporation owns the assets. So why is the price what it is? So you take the company's worth, which equals the total value, which equals the market capitalization, which equals the stock price times the outstanding number of shares. So in other words, if the company's worth $50 million, that equals its total value, which is its market capitalization, which is, if you have $5 a share times 10,000 shares, you have your $50 million valuation. So how do these stock prices change? So supply and demand. It's pretty easy, really. So if people want to sell a stock more than they want to buy it, there's going to be a greater supply than demand, and then the price would fall. However, if people want to buy a stock more than they want to sell it, there's going to be a greater demand than supply, and then the price would rise. Let's go over some buying. You have a market order. This is your basic order. The market order executes the purchase at the market value. So this is executed immediately at the price someone is selling at the exact moment in time, as opposed to requesting a specific price. So if I set a market order to buy something at $1, that's not what this means. This means that I'm going to set an order to buy 10 shares, and it's going to buy immediately no matter what price it is, because it might not be $1, it might be 99 cents or $1.01. So we have a limit order, and a limit buy executes the purchase at a specific price, right? So you're going to say, hey, I want 10 shares of that stock, but I want it at $1. So you're going to set the limit order at $1, and it's only going to buy for you at $1, as opposed to the market order saying, execute now, I just want 10 shares, I don't care what the price is. So as we see here, it is executed at the price that you request, and it may or may not get executed immediately based on the current market value. So if there is no orders for $1, 10 shares of that stock, then that will not execute. It's the same thing for selling. It's going to be the exact opposite. We're just going to run through it quick. It's the exact opposite. A market sell executes at that exact instant. Just say, hey, I want to sell those 10 shares, and I want to sell them now. I don't care what price you give me for them. Just get them off my hands. And then you have the limit sell, which is going to say, I want to sell it for exactly $1.05. I want to get that 5 cents that I bought it for $1, selling at $1.05. That's my game plan. I only want to sell it for $1.05. If the price is $1.04, it's not going to sell. If it's $1.06, it's not going to sell. Only for $1.05. And there's a little bit more advanced we're going to go over real quick as well. Stop loss, stop limit. Stop loss is a price above or below the current price that converts your order to a market order. So you're going to set it kind of like a limit, but it's only going to execute when it gets above or below that current price, and then it's going to execute as a market order. And then you have a stop limit. The stop limit, a price above the current price that converts your order to a limit buy or sell. This is what I'm the biggest fan of when people talk about setting a stop below your price. So, hey, I bought this stock for $1. I want to set it at 95 cents because I want to make sure that I have that safety net of 5 cents or 5% between 95 cents and $1. So I set my stop limit at 95 cents, saying, hey, if this price gets below $1 and it starts going south, if it gets to 95 cents, just sell it. So for stocks, we need to remember that companies that are publicly traded are traded on exchanges such as these right here, the NYSE, the New York Stock Exchange, the NASDAQ, and the S&P 500. These are where stocks are traded. And then we have a few platforms here that trade stocks. TD Ameritrade, which I trade on. Robinhood, which has free fees, which I started on, which is what we're going to do our quick overview on, which I recommend to new traders. E-Trade, and there's obviously a ton more platforms that we could go over. All right, so now we're going to go to the application. I downloaded Robinhood. We're going to select it. It's going to ask for a 4-digit PIN or authenticate by fingerprint. We're going to select fingerprint. It's going to show us our account balance for today or for after hours. We can see a line chart for the daily, the weekly, the monthly, 3-month, 1 year are all of our progress. I don't have a bank account verified right now, so we'll click in the upper left. We'll see our portfolio value, our buying power. We're not going to go over Robinhood Gold today. If you click on free stocks, you can get free stocks by inviting friends to Robinhood. We go back, click on account, and see our portfolio value, how much money we have in stock, how much money we have sitting in cash, which is essentially our buying power. And then down at the bottom here, we can see account statements and tax documents, which are easy transferable documents when we're doing our taxes. Go back, go to banking, you transfer money to Robinhood, transfer it to your bank account, set up automatic deposits after we've linked an account, of course. See our history and see our settings. Go back out to the main page. We're going to go to the upper right to the magnifying glass, and now we're going to buy a stock. So we're going to type in the ticker. We're going to select the stock. You can see the daily, the weekly, the monthly, 3-month, year, and the 5-year on this. We want to buy it. So we can see the order types that we've discussed now. We're going to do a limit. We want to buy it for $8.30. We're going to hit continue. 4 p.m. tomorrow, good for day, and never expires, good till canceled, are two different time and force. 4 p.m. means that if the order doesn't execute by the end of 4 p.m. tomorrow, then it will diminish and that order will no longer be in the queue. However, if we select never expires, that will always be in the queue until that order hits $8.30. So we're going to do never expires. We're going to hit continue. We're going to say we want 10 shares of Corbis. Then we're going to hit review. We don't have money right now, so it's not going to go through. But if we did, the next page would allow us to buy. Now, if we own shares of Corbis, we would also have an area here to sell, and we would be able to sell with also the 4 options that we have to buy. I hope you guys liked the video. Like I said in the beginning, it's just an introduction video to buying and selling stocks. I'm by no means a financial instructor or giving you financial advice. I'm just trying to help you get started buying and selling stocks and giving you information on what it actually is. So if you have any advice for future videos or comments, leave them below, and please subscribe and like. See you next time.